Hello traders, Gary Wagner here just before 11 o'clock in Honolulu, 5 o'clock in New York on Thursday, May 15th, 2014, and this is the daily report for gold and silver. The market giveth and the market taketh away. In other words, we have had a sideways market that continues to trade sideways. After an $11 rise yesterday, we have the markets currently trading off about $9 on the day. On the low side, $12.90.50. On the high side, $13.07, so it has traded over 13 today. A current print, as you can see, roughly $13.96, $12.96, $12.97, roughly off by $9 on the day. Silver also trading in that sideways band, off about 1.37% on the low side, $19.33, on the high side, $19.85. Current print, $19.48, puts it off about 27 cents on the day. More on silver towards the end of the show. You know, traders, after seeing the market break above a short interim standing resistance line, of course, the resistance line I'm talking about was drawn off of these two highs right in here, and then we simply extend the line down. We certainly saw it break above that yesterday. There's no doubt. There's also no doubt that we saw it break right back into the compression triangle in terms of the highs and the lows right in here, which I believe simply shows us more than ever that we're absolutely trapped in the sideways trading range. On the high side recently, we've got 13.12. Of course, we had this 13.28. That was last month, though. We haven't hit that area over these last two tops. And really, if the market continues a little bit lower, what we are seeing, rather than a series of higher highs, and that's what we need to see, higher highs, higher lows as the market moves up. We have gotten these higher lows. You can see that right here. But when we take a look at the recent activity, high, lower high, then we get a higher high. Now we've got a lower high. So again, just as we look at a daily chart oscillating candle color being indicative of a market that's trading sideways, when you get a series of peaks in which you don't have really clear-cut direction, meaning a consistent amount of lower highs as the market moves down, or consistently seeing higher highs as the market moves up, we're not getting that. We're getting almost a small and head and shoulders kind of formation, but we're looking at a 480-minute chart. And when we go ahead and pull up our daily chart, we can absolutely see that that market has been defined really as a range-driven market. And when we're looking at it in this way, and I'm going to try to, well, we'll incorporate the tails also. But you can see better part of April, better part of May, we've got these lows in here. We have really strong support just in terms of the bodies of these candles, standard candlestick chart, roughly at 1280. That 1280 was a low that we hit here, and it has since pretty much held. Now, we've had some lows that have come into this market. In other words, the market would spike down, but the closes were always above this point, whether they be red candles or green candles. The fact that the body size falls above this tells us something. Now, at the same time, when we look at these series of highs, we are getting the same thing. This marketplace is trading really in a manner in which we've got a range-bound market, and we tend to call that a sideways trading market or a range-bound market, and it's really between this area, 1280 on the low, 1310 on the high, and we've not been able to really break above or below that point. It's just trading looking for some direction. Now, all of that in light of an equities market under extreme pressure. I believe the market itself was off about 163 points. And we are looking at the continuous contract daily chart, Standard & Poor's SP 500. We know that we hit a record top right in here. This is 1900, of course. And now you can see after 2 days of down market moves, if this chart is correct, considering the low, it's come well back up off of the lows as it goes into close, 1877. So I don't know what it's down by currently, but it's well off of the lows. But we have had, when we look at this, we have this new record top here, just as it hits 1900. Market corrects from there. You can see this band of support right in here, and the market's just below that currently. It is a daily chart. We'll see how it unfolds as the market goes into the close, and that is currently happening. Now, when we look at this 2-day chart, of course, this 2-day chart has basically our cascading channel lines down. And what we have been trying to determine is we know a breakout above this 0 line is really signaling that we are in for a bullish market itself, as opposed to a rally, a positive rally taking prices higher that's simply a counter trend to this overall bearish market. As long as it trades within this cascading channel line, meaning that the highs don't surpass the 0, the lows don't go below the 100, it's telling us that any kind of a rally, such as here or here, is a counter trend within this overall bearish trend. However, as the market came down, we talked about this, it did find support at the 23% cascading channel line. It traded up to about maybe 3/4 of the way up, and is now, we can see, trading sideways. Now, we're approaching the apex of our compression triangle, but it doesn't look like it's holding any kind of any weight or any salt, because it broke above and it's now back within that. Traders, there's no doubt this market has been a difficult market in terms of the read up in this area. We know where support is. We know there's absolute support at 1180. We've had that double bottom. We've seen it bounce off there, trade through $1,200 pretty effectively. And now what we're looking at, this is our current print, which is 1296. But there's no doubt we've had this sideways action. The sideways action has been the predominant action that we have been witnessing within the market over the last 3 to 4 weeks. Traders, we've looked at this chart before. I haven't brought it up for maybe a week or so at least, and it is a weekly chart, standard candlestick format, but we have a multitude of different fib retracement points in there, so we can look at major points. And of course, on a chart like this, what I'm looking for is what we call harmonics. Harmonics are where more than one of these particular retracement cycles tends to match. So you get 6176 right here. That's a harmonics. That's in a very, very critical or important point. You also get one at 95 and 92, which is your 61 and 50% retracement. And we're right at that point. As you can see, we're at 96, so we're just above it, but let's call it at that point. And that's a pretty critical area because we have the harmonics right in here. And so when we look at all of these different retracement levels, there's really only 2 real matches that we get that are pretty exact, here and here. This one's fairly close, the 36 and 50, although they don't really line up not nearly as eloquently as these. But when we look at where that comes in at, you can see that that actually turned out to be a fairly important number 2 in terms of pegging a top. So these 3 areas are, I believe, pretty significant levels of support and resistance. We are right at this one particular point, so we're not really getting any solid information. A close above that, substantially above us, tells us one thing, below tells us another thing, but we know we have real resistance at around 1400, there's no doubt. But before we even get close to that, we've got to hit 1312, and then I believe 1327 to 1333 is our next band that we would need to take out in resistance. However, I'm not so concerned about resistance right now. I'm absolutely concerned about support, because the basic trend of the market right now on these last few rallies, peaks and valleys, so to speak, has been a lower high. And that, to me, let's go ahead and pull that chart back up. And that, to me, really is a forewarning that we might see this market under pressure. Because, as I said, it broke above it just so slightly, and we have been looking at markets that aren't textbook cases, that are, as I say, difficult at best in terms of the ultimate read in the market. We'll have to see how this pans out. But according to this chart here, we are really approaching the apex. 1, 2, at this apex, will we see any activity, or will we see the market just basically fizzle? We could see that happen also. We have stops in place, but I will look to tighten them up, whether it's today or tomorrow. If the market's under pressure, we're in roughly at this area anyways. We're trading in a sideways market. If it breaks to the downside, we certainly don't want to take any significant heat on this trade. If it breaks to the upside, we certainly want to be able to profit from it. But what we're seeing right now is a continuation of a narrowly trading market, or a narrow range in terms of the trading range within the market, and it has popped above and then back into this particular area, which tells me, on a very, very rough look at the market, that we might not see any kind of major breakout one way or the other because of the way that it is reacting in the markets right now. Now, as far as I'm concerned with silver, we're seeing a greater amount of being range bound. We've got real strong resistance between, call it 1975 up to about $20 per ounce. We've seen the market come up to that point, but unable to take it out. When we look at our series of recent market moves, we've had the market move to the top of the range, then to a higher low, and now once again the market comes up, hits its resistance point right here. And so the question is, it will probably move back down into this range, because we can definitely see that there is some support in the market at around $19 per ounce, and there's absolutely some resistance at the upper 19s to $20 per ounce. This has been Gary Wagner, wishing you, as always, good trading. Talk to you tomorrow for the weekly wrap-up and review. Bye-bye.